Hi, everybody. Thanks for joining us. Good afternoon. I'm thrilled to have you here with us today for this special webinar on securing your financial future in retirement. My name is Carrie Kirkland, and I'm a certified financial planner professional with the Verma Private Wealth Group at Canaccord Genuity Wealth Management. I have over 13 years of experience in helping clients with complex planning needs. And I have found some of the most common questions when going through a complex plan often are around retirement lately, in particular with regards to the shift from their working and savings years to actual retirement and the income flow aspects. It sort of is like a question along the lines of, so I have now accumulated all of this wealth and done a great job of it, but now what? So I think that today you're going to find a lot of helpful information. So I'm pleased to have Jackie Power from Mackenzie Investments with us to discuss some of these hot topic questions around retirement income. Jackie has over 25 years of experience, and she's an assistant vice president and tax and estate planner at Mackenzie Investments. And she regularly meets with advisors and investors to do presentations such as this and answer questions and provide updates on tax and estate changes. So we're really lucky to have her here today and excited to go through all the topics with her.
Thank you so much, Carrie. Thank you everyone for calling in. I'm so happy to be here today and have the opportunity to speak to you with respect to retirement income. This is an area that, as Carrie was saying, it's so important, and there's so many different parts to the retirement income discussion. So very happy to have the opportunity to speak with all of you today and help you get a sense for what's involved when you go from the accumulation phase to that decumulation phase. So here is the disclaimer as far as Canaccord is concerned. And then I also have a disclaimer as far as Mackenzie is concerned. So I am not here to replace any advice that you might be receiving from lawyers, accountants, any sort of tax professionals. The idea today is just to get you some information, get you thinking about that decumulation phase, what's involved with that, and go through that process. So when we're looking at, all of these different retirement strategies, as you can see, lots of different areas that factor into this. We'll talk about CPP and OAS and the decision as to when to take that. We'll talk about income splitting in retirement and some opportunities that are out there with respect to that. We'll talk about converting an RSP to a RIF and some factors that play into that. We'll talk about TFSAs in retirement and how these can be an excellent tool that can be used in retirement. And then finally, we'll talk about the order of asset withdrawals. This is a question that we get a lot of confusion as to, where should we start pulling money from when it comes to retirement? This is some what I'll help you sort of talk about and how you can just help you and help your clients as we go through. So first, as far as CPP and OAS is concerned, I think many of you are likely aware that as Canadians, those benefits are calculated as of age 65. So with OAS, the earliest we can take it is age 65, but with CPP, there are different options. It can be taken as early as age 60, but as you can see here, your clients would have a reduced pension if they were to take it prior to 65. So for every month they take it prior to 65, there's a reduction of 0.6% as far as that pension would be concerned. If they take it as early as 60, it's a 36% reduction that would happen there. But you can see here on the flip side that they're really encouraging your clients to take it later. So for every month that they take it after age 65, it's a premium of 0.7% that they would receive as far as CPP is concerned. If they wait and take it at 70, it's a premium of 42%. If on the flip side, they also, sorry, not on the flip side, but if they also want to take OAS later, it would be 0.6% premium for every month after 65. If they take it at age 70, 36% premium. So that's why I was saying you can see the government really does want individuals to be taking it later. Now, there's the big question as to when should your clients take it? And I wish there was a one size fits all, but there really isn't. It really varies from client to client and what makes most sense. So life expectancy is first something to look at. So if your clients anticipate having a shorter life expectancy, they want to take it earlier. If they have a longer life expectancy, generally it makes sense to take it later. So why don't we look at this from a numbers perspective? So essentially what this is showing you, now these numbers are 2023 numbers. I do apologize for that, but it's not that different for 2024. And it just sort of gives you the general idea. So if your clients end up taking it at age 60, you can see here that their CPP is going to be reduced, but it all depends on life expectancy. So if they anticipate that they're going to live to less than 74, then it makes sense for them to take it at age 60 and have that reduced amount. Now, if they have a higher life expectancy, if they expect to live to say 78, then in that situation, they likely wouldn't want to take it much sooner than 64 in order for them to receive sort of the maximum benefit that they could. So for those of you who are like me and are visual, this is just giving you a visual representation of that. So the blue line is showing your clients who take it at age 60, and it shows if they live all the way to age 100, the cumulative benefit that they would have received is $400,000. If, on the other hand, they waited just 5 years and took it at 65, you can see here that that cumulative benefit up to age 100 would be $550,000. So huge difference here. And here is where you see that break-even age of 74. So as you can see, it really depends on your client's situation, but it's not only life expectancy that we need to look at. Another thing to consider is what are your clients planning to do with that money? Are they going to consume it or are they going to invest it? If their intention is to invest it, well, that changes everything as well. And that changes the break-even number. So we can see here, if they're anticipating investing that, having a rate of return of 1%, well, now that's kicking that break-even age up to just under 75. So not a huge difference, but depending on the rate of return, it does push that up. If they anticipate a rate of return of 5%, that pushes that break-even age up to 79. So it's really important for you to work with all of your clients individually and not try to paint everybody with one brush, because it really, there's so many factors that can change this for your clients. So here again, it's just showing you different rates of return. And essentially, if you have a client who's anticipating an 8% rate of return, well, now that break-even age has been pushed up to 90. So it's really important to factor in, really get as much information from them as you can, and determine what their intention is as far as these benefits are concerned.
Yeah, I
So
completely
other
agree
things that
with
you're
you, Jackie. It's sort of a situation where a client will ask, when should I take CPP or OAS? And usually my answer is, let's go through the wealth plan with you and see what your situation it describes, and then you can just decide on if there's a history of longevity in the family, as well as even if you're not saving the money, if having the CPP means that you're taking less from your investment portfolio, that essentially is almost like saving it rather than consuming it.
Most definitely. And other factors, as you can see here, like you have to look at whether are they continuing to work. More and more Canadians are working later. So that's another thing that factors in. Maybe there's rental income or investment income, like to your point, that they're receiving as well. Maybe they're one of the lucky ones that has a pension plan. All of these things factor in. And that's why you saying you need to look at the big picture. You need to do that wealth plan. It is so important because we can't make decisions just by looking at one factor. It's really important to get that full picture in order to be able to make that determination as to when your clients should take it. So other things to consider is income splitting. Lots of opportunities there for your clients. Many individual Canadians don't realize that they can share their CPP credits for the years that they were with their spouse or common law partner. So essentially, they would make an application to Service Canada, indicate that they wanted to share these credits. And the idea behind this is instead of having one spouse receive a really high CPP, other spouse receive a lower amount, it kind of evens out those CPP amounts between the spouses. Now, this does need to be done with Service Canada. It's not something they can split on their tax returns. But if they wanted to do income splitting on their tax returns, that would be the eligible pension income that they would be able to split there. So any clients who are 65 years of age or older receiving eligible pension income, they can split up to 50% of that with their spouse. So both spouses need to make that election on their tax return. So now is the perfect time to have this conversation with your clients. Get a sense for what kind of income that they've had, that they had in 2023, because now is the time that people are starting to think about those tax returns, and this is the perfect time to get them, at least putting that on their radar. Spousal RSPs, now this is also a great time to have those conversations with your clients. Clients are able to make RSP contributions up until February 29th and be able to determine whether they want to use those on 2023 or 2024 tax returns. So have them look at those spousal accounts, and essentially the higher income earning spouse is the one who would make that contribution to the lower income earning spouse's spousal RSP. It allows them to the contributor to get that deduction. And then the idea again is when they go to retire, those RSPs will be more even, and that'll help the family unit as a whole when they start withdrawing that money from those RSPs. TFSAs are also an excellent account type. I think all of you are likely aware of just how beneficial these are, so I won't go into all of those benefits. One thing I did want to mention is with the TFSA, there's no attribution that applies if one spouse gifts money to the other spouse. So normally if a spouse gifts money to the other one, that money gets invested. Any investment income generated from that would attribute to the spouse who gifted that money. Well, the great thing is with the TFSA is that there is no tax on that money in the TFSA. So there's nothing to attribute back to that spouse who made that gift. Prescribed rate loans, I'll be completely honest with you, right now with a prescribed rate of 6%, these do not make sense. So I won't even go into detail about them. Once those rates start to decrease again, once they get closer to 1 or 2%, we'll start having those conversations again. But at this point in time, it just really doesn't make sense. So let's talk about converting RSPs to RIFs. So I think all of you are likely aware clients need to do that by December 31st of the year they turn 71. When that RIF is established, if you have clients who have a younger spouse and they really want to limit the withdrawals that they have to make from the RIF, they can base those RIF withdrawals on the younger spouse's age. So that's something that's beneficial. As I mentioned, they can also split that eligible pension income with their spouse up to 50%, as long as they're 65 years of age or older. Another thing I would encourage is talk to your clients about beneficiary designations. If they have a spouse, you want to encourage them in most situations to have the spouse as the beneficiary on those registered accounts, because the spouse is able to inherit those on a tax deferred basis. So it's only when that second spouse passes that tax liability would hit. So definitely something to make sure you're discussing with your clients. If you
We
have a
always
client
love
who
to encourage clients to do contingents as well at the same time too, so that if,
yes,
heaven forbid, spouses are traveling places together, you could predecease each other shortly within the same time, and then you'd want to make sure that your loved ones or next of kin have a slightly easier time accessing the funds that you'd like to pass on to them. Yeah.
that's an excellent point, and yes, very important in the planning for sure. Another thing that you are all likely seeing is Canadians are working later and later, and as a result, you might have a client who is turning 71 this year, and needs to still has earned income that's going to be coming in going forward. forward. So one option again is if they have that younger spouse, even if they're over 71 and they no longer have an RSP, but they have a younger spouse, they are still able to make contributions into that younger spouse's spousal RSP. So that's one area to consider. Another thing is making a final RSP contribution. So right now, I'll be honest, January is not the time to make that over contribution, but I just wanted to put the idea in your head just so you could think about it for the year. So essentially, let's go through an example. We have Thomas. He's 71. We're using last year as an example. So he had earned income in 2023 of 150,000. So that would have provided him with RSP contribution room in 2024 of $27,000. But because he was 71 in 2023, he didn't have an RSP in 2024. So what he ended up doing is he made his 2024 RSP contribution in December of 2023. And the reason why you would encourage your clients to do this in December is because it does put them into an over contribution position for December. There will be a penalty that's associated with that, but it's only for 1 month. So it's 1% for 1 month. In this situation, we're assuming that Thomas had never used that $2,000 over contribution amount. So his actual penalty was based on $25,000. So $250 is what that penalty was. But the great thing is January 1st, that over contribution disappeared because of the fact that he had earned income in 2023. And then when he files his 2024 taxes, so that won't be until April of 2025, but when he files those, this is going to likely provide him with savings of about $11,720. So very much worthwhile and definitely something to consider with your clients. But again, only in situations in December. You don't want them to be in that over contribution for a longer period than that. TFSAs are excellent. I think, you are likely having clients who are using these in retirement. I know that my mother does this. She's an avid traveler, always worried about, OAS clawback. So she likes to pull money out to go on vacation without having it affect her net income. So that's exactly what she does. Every January, she gets those contribution amounts that she pulled out of her TFSA the previous year, plus whatever the new limit is. And this year, the new limit is $7,000. So if you have clients who have never opened one, seniors who have never opened one, $95,000 that they would have in TFSA contribution room. So really powerful.
Yeah.
Yeah, right. And
it's
all of
fantastic for estate planning as well, too.
Oh my gosh, it's incredible. It's a great way for people to inherit money, not have to worry about any tax liability on that. Talking about the estate planning side, if you have clients who have TFSAs and they have a spouse, I highly encourage you to have the spouse set up as a successor holder, because that way they inherit the entire TFSA tax-free and can put that entire amount into their TFSA without the need for TFSA contribution room. So really powerful and just an excellent account all around. Whether you have clients who are worried about those income tested benefits, if they're in those high tax rates and just don't want to be pushed, to be paying additional tax but need this extra money, TFSA is definitely a great way to go.
And we've also had clients encouraging their children and their grandchildren to start opening them as soon as they're 18, because it is a great educational tool and a great tool for any goal that you're saving towards.
Most definitely. And I'm finding more and more young Canadians, because they don't need the RSP deduction, a lot of them are making contributions into TFSAs, accumulating their RSP contribution room. So once they actually, need those deductions, they have those extra amounts that they can put. And some are even taking money out of the TFSA at that time and making the contribution into the RSP. So lots of options that are available for sure. Order of asset withdrawal. This is something that's really important. And this is something that our team is really interested in helping individuals with, because it's an area where there's a lot of confusion for Canadians. Where do I take the money? And lots of different factors that you need to look at with respect to that. So tax credits need to be looked at, because a lot of the tax credits are income tested. Different sources of income are taxed at different rates. And then also looking at that RSP or that RIF exit plan. So let's look at each of these in more detail. When we're looking at the age amount, this is available to Canadians who are 65 years of age or older. And it's, you know, a large credit if they're eligible for the maximum amount. But the problem is that once their income goes over 44,325, that age amount starts to be reduced. And once their income is 102,925, at that point, they're no longer eligible for that age credit. So that's where it comes into looking for more, you know, types of income that aren't going to affect their net income as much. Pension income amount. This is that the first $2,000 of eligible pension income that your clients who are 65 years of age or older receive. They can be eligible for that 15% credit on that first 2,000. So this is another reason why income splitting can be beneficial as well, because that way both spouses can double up. And again, it's going to reduce that tax bill for the family as a whole. And that's what we sort of want to look at, is always the family as a whole. All of us have those personal amounts. For 2023, it was $15,000. If you have clients with our aging population, lots of medical expenses out there, lots of attendant care expenses. Many Canadians are eligible for the disability tax credit as well. So these are all things to talk to your clients about. Make sure that they're aware of them and make sure that they're taking advantage of all of those as well. So I'm briefly going to talk about this and essentially say that different types of income are going to be taxed differently, but these ones all on the bottom, whether it's government, whether it's like the CPP-OAS, employer pension plans, RIF, LIF, RSP withdrawals, all of these are fully taxed as income. So yes, we need to be pulling this money out, and that needs to form part of retirement income. But it's important for your clients to look at other sources of income as well. You know, dividends, capital gains, only 50% of the gain is taxable. That's a great way for your clients to be able to receive retirement income. And that is going to form part of this overall plan when they do retire. And as I said, TFSAs are excellent. If your clients happen to have corporations, if they had shareholder loans that they had made to the corporation, they can extract that money tax-free. If they have money in the capital dividend account, that allows them to pay out capital dividends, which are tax-free dividends. So these are all great ways that your clients can supplement their retirement income, and it all goes into one big picture, if you will. So let's talk about the exit plan. And this is really interesting because for years, we had been told, you know, delay, 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 try to keep your money in your RSPs as long as you possibly can. That is, I see Carrie shaking her head. That is not a good option at this point. Our tax rates are so high right now. If you have clients in the top marginal tax rate, that's 53.53%. It does not make sense for your clients to delay this. And so what I'm finding is that more individuals, when one spouse passes, instead of rolling the entire RIF or RSP on a tax deferred basis to the surviving spouse, they're rolling a portion of it, because a lot of the time the spouse that passed away frequently doesn't have a lot of income. So it makes sense to have a portion of that RSP or that RIF taxable in their terminal return. Then that frees up that money. That money can then go into a TFSA, or that money can go into a non-reg account with the surviving spouse. I had a really sad situation not that long ago where essentially there was this gentleman who had $1.5 million in his RSP and no other assets whatsoever. And he was saying to me, so each of my sons is going to receive $750,000. And I said, no, that's not the case. Like, there's going to be over $800,000 in tax on this. Your sons are going to be sharing less than $700,000. And he was shocked. He had no idea. He had been taking out the minimum amount, trying to save as much for his sons. So then we had that conversation. We're like, okay, start taking more money out now. Start putting that into your TFSA. Start putting that into non-registered investments, making it so that the tax liability is a little less. And I think you'd be surprised at how many Canadians just do not realize how heavily taxed those RSPs and RIFs are at time of passing.
Yeah, your biggest tax bill is at your time of passing, and a lot of people stick with the old oh, I have to riff at 71, and no, it really is a unique situation that you need to take a look at and decide what makes the most sense. And again, when it's rolling over to the spouse, it is amazing that you can do that on a tax deferred basis. However, sometimes it does make sense to trigger the tax just to smooth everything out. So completely agree with you.
Yeah, yeah, no, it's so important. And again, it goes back to your initial point. Look at the big picture. Don't just be
Yeah.
looking at one account individually. It's really important to look at their overall
Yeah, and
situation.
another topic that we come up with sometimes too that people don't realize is you can open a RIF account at age 65 and you don't have to put the entire contents of your RSP in there until you're 71. So if it makes sense from a taxation standpoint to take X amount of dollars from your RIF, you can make that happen so that your taxation gets smoothed out over more years.
Most definitely. And that's an excellent, excellent point. Definitely. So what our team found was that there's a lot of confusion as far as order of asset withdrawal is concerned, and we wanted to make sure that we could help advisors and help your clients through this process. So essentially, we partnered with a company that had software that helps us as far as this is concerned. So we ask for all sorts of information as far as the clients are concerned, not just assets that they have with you, but assets that they have throughout, as far as their entire portfolio is concerned, so that you can get the big picture, and then from there help them determine where they should be pulling assets from. So let's go through an example. Here we have Tom and Gina, and they own a corporation. It's TG Inc. Tom owns 95% of the shares, and Gina owns 5%. So she was originally put on as a shareholder in an effort to do some income splitting. And then many of you know the rules changed in 2018. So it's not as easy to income split with your spouse if your spouse is not actively engaged in the business, except when it comes to one of the exclusions is when an individual is 65 years of age or older. So in this situation, because Tom is 65, he can actually dividend out to Gina instead of having TOSI, which is tax on split income, apply, which means that dividends she would receive would be taxed at the top marginal tax rate. Because they meet an exclusion, it ends up those dividends are taxed at Gina's marginal tax rate. So much better in that situation. So not only do they have the corporation, but they also have other assets. So Gina has a defined benefit plan where she's receiving $20,000 a year. Tom's collecting CPP of $10,000 currently, OAS of $7,000. Gina's going to start collecting CPP at 65 and is anticipating receiving $14,000 annually and the maximum OAS. Now, another thing that we factor in is if they're planning to sell their home and downsize, we can factor in what they're receiving with respect to that sale of that home. Maybe they anticipate receiving an inheritance. We can factor that in as well. Sale of a business, all of this gets factored in. So it really gives, clients a very good understanding of are they going to be okay? That's the biggest question that I think a lot of individuals want to know. Can I retire now? Am I going to be able to live the life I want? So with Tom and Gina, they want $120,000 net a year. So not only do they have, what we just discussed, but here are their other assets as well. So Tom has 400,000 in an RSP, Gina 200,000, 90,000 in a TFSA, 85,000 for Gina, non-reg for Tom of 300,000, and then within the corp there's $1 million. So 400,000 in cash, 600,000 in investments. So all of this is factored into the analysis that we do. And essentially in their situation, what we found is that most definitely they are going to be okay. So they can easily have that $120,000 net. You can see here it's showing their estimated passing of 92 and 90. And at that point, they will still, even after taking that much money out over time, they'll have $1.7 million. So this report that we do is really very comprehensive. So it provides information as far as what their net estate is going to look like over the years. It gives an example over the first 5 years of where they should be pulling money from. It shows what their OAS would be. It shows if it makes sense to pull out of non-reg, how much they should be pulling out of registered accounts. It's just sort of giving a roadmap. So it's not set in stone that this is what your clients have to do. It's just giving them a starting point and helping you also understand, okay, from a tax perspective, from a net estate perspective, what makes sense in this particular situation. And then we took it another step with Tom and Gina and said, okay, what is the maximum that they could receive? So you can see here, just under $148,000 net every year, and they would still have a net estate of $851,000. So still lots of money that they can leave behind for any children. So we're really just trying to help all of you and help with a starting point as far as, some of these questions that come up on a regular basis from clients with respect to retirement. So that's what I wanted to cover. And I don't know if there are any questions or if we have the ability to take questions, but if there are, I would be delighted to take them.
Just wanted to add to what you had left off with there. I do find that going through the wealth plan usually gives clients a lot of information that makes it a lot easier to make decisions, plus as well as partnering with us as a trusted professional to help them. So I find the beginning stages, the wealth accumulation stages, when we do the wealth plan, is very different than once they're going into retirement. And the questions that surround how we help a client with that. And also, there is also the softer areas too, in the sense that you've spent your life receiving a regular paycheck, either monthly or annually. And then now you have all these various vehicles that you've done a fantastic job of accumulating within. And now you have to sort of shift your whole mindset into a different way of thinking. And it can be hard to do that. So we partner with a lot of clients in order to help them find that blend, in order to, sometimes we'll take all of the different various payments, put it into one source so that they get that one paycheck that they were used to, because they find that's more convenient. And we'll also partner with their accountants and their estate planners. And throughout retirement, I find the conversation when we do their plan update really starts to shift to estate planning and ways that we can help with planning for any inheritance they want to pass on to their heirs. Or there's a common one where I want to spend every single penny. Okay, great. Let's try to figure out how to do that. And going about it in the way where we can say, how can we make minor optimizations or improvements, or provide you with information to help you be able to go and do that. And we are more than happy to help clients with whatever level of service they want or don't want. And I find that one of the biggest things lately has been regarding the retirement, and it's completely understandable. You spend your life focusing on your area of expertise and working towards this moment that when you get there, it sort of becomes a now what? And that is a great place where we do find we add a lot of value for clients, just because every situation is so unique with spouses, corporations. Do you want to leave an inheritance? Do you not? Etc. So yeah, just to leave off from there, if there's any questions that anybody has, we'd love to take them. Otherwise, hopefully we started to scratch the surface of some of the burning questions. I know it's just introductory. We can't go into a lot of detail about everything in a call and a webinar, but if there are any other areas that are burning questions, I'm sure Jackie and I would love to host something more specific to delve into it. I'm sure you're the same as me, Jackie, where you just love talking about this kind of stuff. So
I really
always
do.
happy to help. Let's
Awesome.
see if there's any questions. Looks like there aren't any, so we'll just leave it at that. And if there's anything that comes up on anybody's minds, feel free to let me know. I'm always happy to chat, and then we can always chat with Jackie about any other areas that we find are burning questions that we might want to focus in on.
Great.
Thank you so much for your time.
Thanks, everyone. Have a great afternoon. Bye-bye.